Okay, welcome everyone. Bienvenue tout le monde. My name is Ryan Katz-Rosine and I'm an associate professor in the School of Political Studies in the Institute of Environment here at the University of Ottawa. And I help to run the International Political Economy Network, or IPEN, with my colleagues Dr. Pascal Massot, Dr. Christopher Huggins, and Dr. Jacqueline Best. Welcome to this event, Paying for a Warming World, Contemporary Challenges in Climate Finance after COP27. I'm joining the call today from the university campus, which I want to acknowledge is located on the unceded territory of the Algonquin Anishinaabe peoples. We here at the University of Ottawa were lucky to be offered Algonquin language classes last year at the University of Ottawa. So I'm going to try my best here and say Kwe Kakina, Ryan Nidijnikas, Wakefielding Nidonjiba, which roughly means, I hope, hello everyone, my name is Ryan, I'm from Wakefield, which is in Quebec. Okay, we're in for a real treat today. We've got 4 experts from various spots around the world joining into this call, which I will add is a very low carbon roundtable. And they're going to share their wisdom on various aspects of the broader world of climate change finance and development. And I want to start off by making a little bit of a confession, which is that this event was largely born from my own selfish desire to really learn more about contemporary challenges in climate change finance, particularly since COP27 in Egypt last year, and hearing from people in the know, because it's been a little bit hard and tricky as someone who's not an expert in this particular area to kind of follow along all the various sort of pools of development financing and initiatives for mitigation finance and adaptation and loss and damage and all of the intricacies and debates about these things, both globally and domestically here in Canada. And of course, one of the great privileges of being a professor is that, when you send out invitations to experts to come and participate in a roundtable, they might just say yes. So I really appreciate that. And before I do turn to our speakers, I just want to say a few things about the format of the event and a few thank yous. So first of all, a quick thank you to 2 of my PhD students, Anna Soar and Taremba Ambeuva, and also to my colleague, Dr. Patricia Fuller, for some of the early organizational support for the event. Also want to thank Anna Bojic for all of the logistics support. Anna's the coordinator for the Center for International Policy Studies, which is where the IPEN network is housed. Okay, so just want to lay out how the roundtable is going to play out. I've asked each of our 4 panelists to speak to the broad theme of climate finance from their own area of expertise for 8 minutes each. After each of the speakers speaks for 8 minutes, I'm going to turn to one of the other panelists just for a very, ever so brief reflection sparked on by what they just heard from their fellow panelists. And then we're going to go on to the next panelist. So once we hear from everyone, we may have a short discussion within the panel before turning to the audience for questions. So if you have a question, the best thing to do is to enter it in the Q&A. So click on the little Q&A button. The chat is sort of demobilized for this event, so you'll want to make sure you use the Q&A. So without further ado, I am going to introduce our first speaker. So Leah Achampong is the Senior Policy and Advocacy Officer of Climate Finance at Eurodad, and she's going to give us an 8-minute talk. I'll keep time and give you a brief sort of nod, Leah, if you go over that, and then we're going to have very brief reflection on this from Julie before moving on.
Thanks. So hello, everyone. As Ryan said, I'm Leah. I'm very happy to be joining you all today. So let's start. Unfortunately, we've all seen the catastrophic climate impacts taking place around the world, where entire communities are being displaced by floods and droughts, and girls are being pulled out of school to help their families with care and agriculture duties in the wake of climate impacts. And global South countries are forced to take on more debt to finance climate action. But currently, there's a massive shortfall in climate finance. OECD data shows us that the current global annual 100 billion climate finance goal has never been met, and between 2013 and 2020, approximately $381.6 billion US dollars, or 48% of climate finance, was not provided by developed countries to meet this goal. So clearly much more progress is needed to close this gap. I think that the most progress on climate finance in the last few years has been on finance to address loss and damage. Loss and damages are the consequences of climate change that can't be reversed through mitigation or adaptation measures. I remember at COP21 in 2015, there was a huge push for loss and damage to be reflected in the Paris Climate Agreement, resulting in a whole article. But it took another 7 years for all countries to agree on finance to address loss and damage, resulting in the Loss and Damage Fund being established at COP27 last year. But this is nearly 30 years after the first request on loss and damage was made in the 1990s by the island nation of Vanuatu. Significantly, the Loss and Damage Fund will provide finance to address loss and damage, but developed countries wanted the fund to provide finance to avert, minimize, and address loss and damage, as this is the language in the Paris Agreement and under the UNFCCC, the UN Framework Convention on Climate Change. However, averting loss and damage can be financed via mitigation flows, and minimizing loss and damage can be financed via adaptation flows. But until COP27, there was no flow for addressing loss and damage, which is why the COP27 outcomes are so significant. The aim is for the Loss and Damage Fund to be operationalized during COP28, and it will be crucial to ensure that principles of equity underpin it, along with ensuring there's equitable board balance between countries and gender balance on boards, and that the financial mechanisms to disperse funds don't exacerbate debt dynamics, and that there's fair access to finance. However, while significant progress has been made on finance to address loss and damage, I also see that there are still significant challenges and obstacles in the current climate finance architecture. For instance, more needs to be done to ensure that climate finance doesn't exacerbate indebtedness in countries, meaning that the financial mechanisms used need to be suited to the economic circumstances of a country, because high volumes of debt repayments choke available finance to implement climate measures. In 2020, OECD data shows that 48.6 billion US dollars, or 71% of climate finance from developed countries, was provided in loans, whilst IMF and World Bank data shows that low and middle income countries spent 372 billion on total debt repayments in 2020. That's about 4 times as much as the climate finance they received as loans. So it's really difficult for global South countries to domestically finance climate action, and there's a real need for responsible lending and borrowing principles to be followed, but clearly they aren't. But crucially, I think climate finance should be provided as grants to reduce indebtedness, but more needs to be done to address these debt dynamics. So in addition to grants, an automatic debt service suspension mechanism should be granted after a climate event. Some global South countries are already adding climate clauses to their debt issuance to enable debt service suspension, such as Barbados, and some lenders are exploring this option too, such as the Inter-American Development Bank and the UK's Export Finance Agency. But it's not enough, and more broadly, multilateral development banks, or MDBs, are being asked to play a larger role in climate finance and debt. The COP27 decision texts invite institutions attending the World Bank IMF spring meetings this April to discuss financing options on loss and damage, but additionally, some global South countries are already planning to hold discussions on innovative financing instruments for effective debt restructuring, which will also have bearing on climate finance. It's good to see that these types of synergies are being sought out, but the involvement of MDBs does not automatically lead to positive development outcomes. The practices and policies of some of these institutions have not always adequately supported sustainable development outcomes, protected human rights or the environment, or been accountable. For instance, the IMF and World Bank apply fiscal policy conditions to some of their loans, leading to some global South countries implementing austerity measures or privatizing public industries in order to meet fiscal conditionalities. all of which can lead to a reduction in high quality public services, such as access to clean drinking water, which is vital during and after extreme climate events. I also see another challenge as being ensuring the additionality of climate finance. Under the UNFCCC, the UN Framework Convention on Climate Change, developed countries should provide new and additional financial resources. But analysis of OECD and UNFCCC data shows that only about 6% of climate finance between 2011 and 2018 is new and additional to development finance. This has consequences for climate vulnerable countries that are also middle or high income countries and so aren't eligible for either climate related official development assistance, ODA, or for climate finance via the World Bank's International Development Association. And so these countries have fewer opportunities to access highly concessional climate finance, which is another reason why meeting the UNFCCC climate finance commitments, as well as increasing overall international financial flows, be it ODA, climate finance, humanitarian assistance, is crucial. To be effective, climate finance also needs to be gender responsive and intersectional, but disaggregated data on gender, race, and intersectionality is often absent from developed countries' submissions on climate finance. This then makes it harder to identify needs and best practices and to adequately support vulnerable and traditionally marginalized groups, such as Indigenous women, racialized women, and the non-gendered community. Developed countries should begin conducting intersectional gender analyses to determine differing needs and interests and levels of accessibility to finance and and to determine the power dynamics. Countries like Canada have frameworks in place, but more is needed. Ultimately, for climate finance to be effective, there must be democratic country ownership of climate finance strategies, but country-driven is not the same as government-driven. So communities and local stakeholders must be included in designing policies to meet their own specific circumstances and domestic needs, as opposed to the priorities of climate finance contributors. The current process to set a new post-2025 global climate finance goal is the best opportunity to transform the current climate finance architecture to make it fit for purpose. I'll stop now, but I'm looking forward to discussing these findings and recommendations with you more in the discussion. Thank you.
Thank you so much, Leila. It's an excellent start. Really appreciate it, and appreciate also the precision on timing as well. So thank you. So we will turn now to Julie just for an ever so brief reflection. Is there anything that popped out at you from what Leila had to say?
Thanks, Ryan, and thanks, Leah. That was an excellent opening, and I'm very glad to have the honor of reflecting on that. You opened by recognizing how climate change is a threat multiplier, right? Climate change is an issue for gender equity. It is an issue for debt and international countries' economic stability. So opening with that is so important because that should inform all types of climate finance. Any area where that isn't the base point, the priority to address, is a problem. I also appreciate how you highlighted loss and damage as a point of progress, but contrasted that with the lack of progress in some ways on the $100 billion goal. So countries committed to funding $100 billion annually to support the most vulnerable countries, and that has not been delivered, as you cited from the OECD, as we saw, discussed significantly at COP27. And that is a broken trust between global North, wealthier, more industrialized countries, and global South, more vulnerable, less historically emitting countries. So 100 billion goal is not fulfilled. It's broken trust. The promise to bring forward loss and damage is a way to repay that trust, but only if countries like Canada step forward and fill what is still an empty bucket. I'll leave it there.
Wonderful. Thank you, Julie. So we'll now turn to Rishikesh, and I'm going to leave my camera on. I'll turn my mic off. I'm going to invite the other panelists to also turn on your videos. I think we're on presentation mode, so it'll mainly be the speaker who you'll be able to see. But I know personally, I when I'm on Zoom, when I'm speaking to a bunch of sort of black boxes, it is a little bit harder to see who's on the other receiving end. So I'm going to leave my video on. You'll be able to look at me, Rishikesh. I invite the other panelists to do so if they would like as well. So we're going to turn to Rishikesh Ram Bandari, who's an assistant director of the Global Economic Governance Initiative at Boston University's Global Development Policy Center. So whenever you're ready, Rishikesh, go ahead. You have 8 minutes. And then following Rishikesh talk, we'll have brief remarks from Leah.
Great. Thank you so much, Ryan, and thank you for inviting me to speak. It's a great panel, so I'm glad to be joining this conversation here today. What I'm about to say actually, fortunately, builds very well, I think, and I hope from what Leah has been talking about in terms of the linkages between climate finance and debt. And so I'm going to touch on that a little bit before I move over to multilateral development banks. But hopefully with these two pieces, I hope to contextualize the climate finance discussions in this broader international financial architecture discussion so that we don't just focus on the UNFCCC process, but also think about the larger, the surrounding institutions that also need to reinforce and support climate change actions as much as possible. So to begin with, I think, as we all know, oftentimes when we talk about climate finance, usually, unfortunately, it's done in a very abstract way. It's done in the language of mobilizing investments, and oftentimes the fiscal constraints that countries actually have do not really enter the picture. Now, right after, or as we're sort of seeing the tapering end of this pandemic, we are witnessing very high interest rates in advanced economies that are directly impacting the ability of many emerging market and developing economies to sustain their debt burdens. We are seeing a massive depreciation of currencies, which makes the problem of debt servicing even more problematic and challenging. And so we are really in an environment right now where the interest rates are high, which means the cost of capital is high, energy prices have gone up. And so, some people have been calling this the poly crisis, and it truly is a situation where there is a lot of difficulty for many of these countries to continue, in terms of the fiscal constraints that they have. And so, when we talk about increasing the scale of investments in these countries, I think it's really difficult to avoid the discussion of debt, because if it's mathematically impossible for these countries to be increasing the scale of their investments, we're never going to really move the needle, right? So I think we really need to recognize the actual constraints that debt really poses on the ability of these countries to mobilize finance. And so in this regard, it's, I think, extremely important to remember that according to the IMF, for example, 2/3 of low-income countries are already under or actively in debt distress. UNDP came up with a list recently where they identified 52 countries. And so, regardless of what the precise number is, you can tell that, this is not just one or two countries. It's a significant chunk of global South countries that are actively, in or at high risk of debt distress. And of course, if you take that alongside some of the recent numbers in terms of climate finance mobilization needs, you will see that the numbers are pretty massive, even though, of course, they will generate returns. These are productive investments, but however, they will have to be made one way or the other. And some of the estimates from, for example, the Songway report are saying that the mobilization needs are around $2.4 trillion a year. And this includes China by 2030, right? These are annual numbers. Now, the problem that we face on the debt side, there's one last thing on this before I switch to MDBs, is that the current architecture for resolving these issues has not really been effective. The G20's framework, called the Common Framework for Debt Treatment, has yielded very little results so far. And so we really need to reform this process so that it can be much more fit for purpose. Creditors need to come on board. There has to be speedy and timely and effective resolutions so that countries can finally get back to the there's, in a sense, ordinary business of pursuing their development and climate change goals. And so there really has to be a dedicated process to really retool this particular framework. Now, there's also, switching over to the multilateral development bank side, there's also a lot of discussion going on in regards to especially the World Bank's role and what's called the evolution roadmap process, where a number of G7 countries, as well as some others, tasked the World Bank management to come up with an evolution roadmap that identifies how its vision and mission would change, how its operations would change, and how its financing model would change. And I think that's, these three components are, really important for, I think, our discussion here today, because what does expanding concessionality to climate vulnerable countries mean? If that is what the World Bank should do, what does that mean for how much resources the World Bank has? Does that introduce trade-offs against other sectors that it works in? And so how can we ensure that the access to concessional finance is not limited only to low-income countries, but is available to a broader set of countries as well? Because as we know, adaptation, loss and damage needs, these are huge for many countries, even though you may not be a low-income country. And so I think there are these reforms that are currently in discussion. And so this concessionality of finance from the World Bank is one particular piece. The second is in regards to the total volume of finance. And now some of you may be following this, but there was a report by the G20 on how multilateral development banks could optimize their balance sheets to increase the scale of finance. And but of course, alongside these balance sheet measures where the risk appetite of these banks would increase, we also need injections of fresh new money, especially if we're going to focus on concessional finance, which, again, as Leah was also pointing out, it's extremely important for countries because, you can't just be introducing more and more debt. It really needs to match the situation that countries are in right now so that these tools are actually used and implemented. And so, yeah, let me sort of pause there and see if there's any reflections. Thanks.
Wonderful. Thank you, Rishikesh. It's a great follow-up to the first talk. So we're now going to see if Leah has any brief reflections on the what was just heard.
Yeah, thank you. I think there's a lot to unpack there, but I think the sort of big key message coming out of the intervention from Rishikesh is that there's a need for reform, and I liked the term retooling actually that you used, because it is about sort of going into the architecture and finding out what isn't working at the moment, what can be improved, and retooling things and thinking about it in this way. It's visual, but it also is a clear sort of analogy for what needs to happen, and also the point that you made around the need to move the needle by recognizing debt dynamics. That's so crucial now for all of the reasons that you shared beforehand, but also to ensure that future generations are not having to have their livelihoods impacted as a result of them not having access to good quality public services because their governments are having to repay the debt from previous generations of governments due to the poor sort of lending and borrowing principles in place in multilateral development banks or international financial institutions. And just to finish, contrasting of the two architectures, I think this is an emerging area of research but has been one of debate for a number of years. And I'm looking forward to seeing more what can come out of those discussions to understand how we can retool these different architectures. So I'll leave it there, but looking forward to the discussion. Thanks.
Wonderful. Thanks, Leah. And one of the sort of motivations for having these 1-minute reflections is that it helps animate some of the discussion for when we turn to a broader discussion later on. So we're having some excellent feedback and reflections, which I think are doing just that. So next up, we have Mariama Williams, who is a feminist economist working on economic development with a focus on gender equality and women's empowerment and climate change issues. So Mariama, whenever you're ready, you're at 8 minutes. And then following Mariama's talk, we'll have Rishikesh provide a short reflection.
So good morning, good afternoon, fellow panelists and all of the fellow joiners of this event. Look forward to talking with most of you. So far, I've been really very pleased by the interventions by the panelists before me. I want to draw on a couple of things. One is I want to draw a little bit on the role of the World Bank in particular and MDBs. Talk a little bit about the quantum and quality and the disbursement and access to finance, because that's a long-going thing. And I would agree with Leah that one of the truly progressive element in the state of climate finance where we are right now is loss and damage. But the other part is the recognition of just transitions, which I'll refer to in a minute. So let me just step back a little bit and say what climate finance is. Right, because we've scoped the literature. I was the initial coordinating lead author for chapter 15 of the AR6 for the IPCC. And during the pandemic, then I had to step away because of pandemic things, but I remain a lead author, contributing on the question of gender, the question of measuring climate finance and other things. So, and I want to draw on that report because I think that is one of the most significant report. And most UNFCCC decision-making follows or are led by what the IPCC says. And you could actually trace many of the decisions that come out of UNFCCC to IPCC. So it's very relevant to international climate making. So AR6 becomes very important in that regards. And chapter 15, which looks at investment and finance, is one of the key innovation in the IPCC that finance had a role. Significant role. And we looked at many things, including local financing, and look at gender, look at a whole cross range of things that are correlate. So just to start that, when we talk about climate finance, and sometimes climate finance get conflated with environmental finance, sometimes sustainable finance. And so we have to begin to try to unpack that a little bit. So within the context of UNFCCC, we're talking about financing that support adaptation and mitigation, technology transfer, and capacity building to support developing countries. And the finance are meant to be provided by developed countries, named Annex I countries under the UNFCCC. Broadly in the discussion and in what we scope the literature, we look broadly at that, but we also look at financing mobilized by developed countries through their private sector. And we also looked at private sector's own financing of climate and environmentally related investment along these category of sustainable finance, which looks at socioeconomic impacts, poverty alleviation, and women's empowerment and indigenous peoples and ethnic minority groups in these things. And that's why just transition becomes a very important concept. Though it originally emanated from trade union work, we have been broadening that to look at issues of gender, issues of what's happening to indigenous people and ethnic minorities on the ground, and low-income people who are affected by environmental and climate justice, both in the US, Canada, and elsewhere, as well as between the North and the Global South. So I just want to flag that. So the quantum of finance is important. Finance is the wheel for the economy. Finance is the glue for undertaking mitigation, adaptation, action. and of course for dealing with loss and damage that are affected by low-income countries who are the least responsible for climate change and who are the ones who are bearing the burden. The disbursement of the climate finance. So climate finance is an obligation. It's a legal obligation under the CCC that developed countries agreed to. And that's why the $100 billion has always been on the table. And there's many nefarious working around that. And that has been, the number was put on the table before. The OECD has put out a number of reports showing that even though in 2009, when it was first mooted, and 2012 under the Cancun Agreement, $100 billion per year. It wasn't $100 billion by 2020, it was $100 billion per year by 2020. That is suddenly now $100 billion by 2020. So we constantly see the goal points shifting. And so that needs to be addressed, and that needs to be addressed in terms of grants and not loans, as been affected before, because of the state of the economy, not just economy, but because of climate debt. The fact that, as I mentioned before, is who's responsible for the overhang of GHG gas in the environment. So I want to put that on the table very clearly, right? This idea that we're going to rely on the private sector to solve climate change, I think it's a myth. There's no global problem that the private sector has solved, okay? The Marshall Plan, which led to the redevelopment of Europe, was led by government. Rural electrification in the US was led by government, right? So government plays a critical role in public finance. And yes, certainly we want to leverage private finance, but let's be very clear. Private finance is about making profit. And we don't want climate change to be a profit-making endeavor that impacts the lives and livelihood of men and women in developing countries. Which brings me to the World Bank and the MDBs. I think the World Bank posed a moral hazard problem in development finance and now in climate finance. Right? It is the entity that everything goes through. Nowhere in commercial finance or in any democratic liberal processes do we have one entity through which everything goes through, which is opaque and lacking in transparency, and which the governance of it is set by the US and a few developed countries. Right? It's the trustee for most all of the climate fund. It runs its own funds. And increasingly, we're talking about it being also the arbiter of loss and damage. I think that is a huge problem that we're going to have to contend with and reckon with, no matter how much we shirk from it. The operative word in the names of the World Bank and the multilateral development is bank. Okay, banks are profit-driven entity, right? They offer loan, they offer financing, whether you talk about concessional financing or co-financing. Co-financing is a contributor to the debt in developing countries. Look at the Philippines, look at any developing countries. The fact that they have to co-finance means that many times they borrow from the same entity who are co-financing their enterprise. So I think the whole reliance on MDBs, yes, they needs to be reformed. I don't think we can optimize them or allow them to optimize their balance sheet on the backs of the poor, which is what's been historically going on. And climate debt now being the thing that's now keeping the World Bank afloat. And we need to examine why that is. I think all of these institutions have to be remade to fit purpose and the purpose of the 21st century in the context of war, in the context of inflation, in the context of pandemics, COVID just being one, and multiple other kinds of things that are going. So yes, we need the private sector. Yes, we need some entity, global multilateral entity. I don't know that it has to be the World Bank or MDBs. I know the developed countries are allergic to creating new institutions because they lose control and they want to control where they are with it. But the question is, does it work? Does it do what we need to do to solve the global issues and problems that we have? And I would assert that it doesn't at the moment, the way they sit. I think I'm less than sanguine, and less than sanguine, I think, about the loss and damage fund. Great that it's been muted. Great that the EU finally stepped out and left the US isolated. So the US had to agree because the US is, but they're all been stumbling block to financing loss and damage. So why it wasn't in the Paris Agreement, but in the covering document, all right? And that was under Obama, okay? Let's be very clear. All right, so what we're seeing is the fund is muted. Remember the Green Climate Fund, to which the $100 billion was supposed to meant, was agreed to in 2012. That fund became operational in 2015. That was 3 years later. And only after a long fight and a sustained intervention by developing countries through an entity that I worked with, the South Center, and working with many different developing countries, the Africa Group and others. I think the loss and damage fund is going to be similarly a huge fight. It's not going to be activated by the next COP, if history is the proof. The climate fund, so far Europe has not nominated members for the so-called transitional committee. That would be it. They haven't settled the question of the definition of loss and damage and who will pay. The US is insisting that China, India, and others be part of the payment. And which is why I start out by saying about climate debt, because that's going to be a sticky point all along the way about who is going to be part of this contribution to the fund. So yes, it's been muted. Yes, it's going to take a lot of work. I've spent my first 5 years at the South Center working with the Transition Committee to set up the Green Climate Fund, and spent many years fighting, even up until now, constantly fighting the developed countries who are constantly trying to put more and more loans in the Green Climate Fund, right? And so I could see similar dynamics coming around the loss and damage fund. So I think civil society and all of us have to be very careful that we have to be on guard. We have to put up a very strong fight, or this fund will be a fund in name and it looks really good, but it will not do what it needs to do for the people, in particular in SIDS and in the vulnerable countries of Africa and Asia, much less for middle income countries where most of the poverty population live, are in middle income countries, India, Brazil, and other places, all right? Gender justice is a very critical part of climate finance. It's another kind of my work, is to look at how much of this money has been going to projects in communities at the local level. And for women, everybody is saying women are important. We have every entity are very gender friendly, but how much of that money goes and service the needs of women and men in terms of care, in terms of the basic development of the local community infrastructure, to provide water, to protect their agriculture, to protect and food security. So trade also interlinks here. And so we also have to look at the emerging nexus between trade and climate, and how we are going to be able to keep those in a way that maintain equality and justice. Justice is at all levels: gender, indigenous people, disability, and all of the different LGBTQI. So I think it's very, very important that we are very conscious that these decisions are. I've never met a COP. I've worked in climate change since 2008, and there was never a COP that didn't have a significant outcome. The question is making that outcome into a reality, and that's where the fight then becomes. So outcomes are always great. Paris Agreement was a great outcome. How much of it is implemented? Cancun was great. Lima was great. They were all great. They all came up with something innovative, right? But where are we? In 30 years of UNFCCC, we haven't bent the emission curve. We haven't protected the majority of the people on this planet who are living in conditions where the slightest hurricane comes and there is death. When extreme weather event comes in developed countries, we lose property. In developing countries, we lose lives, men, women, and children. That is the basic. Climate change is basically inequitous situation. And that's why climate finance of the kind and the quality is very important, to move it into communities at the community level. I will stop there because I'm sure I've overrun my time, as I tend to.
Only a little bit, but that was excellent. Thank you so much, Dr. Williams. And you started to answer some of the questions I've been jotting on the side here, but we'll come back to that. And I really appreciate the sort of insertion of political economic analysis. So thank you so much. I sense that it might be some slightly different take on World Bank and sort of profit-oriented financing, maybe not, from Rishikesh, based on Rishikesh's former talks. But Rishikesh, what was your sort of reflection on what you heard from Mariama?
Yeah, great. Thank you. And thank you, Mariama, for those remarks. Just to start with, I fully agree with Mariama in terms of how difficult it's going to be to get this loss and damage facility up and running in a way that will actually truly be effective. We know the how long and arduous just the process was for the Green Climate Fund, and yet it's been a challenge to even get the second replenishment process started. And so there's, I think, perhaps a moment to think about our past experiences to make sure that the loss and damage facility design really takes those lessons to heart. I think on the World Bank, I think something we really have to be clear about is, of course, there are these discussions regarding increasing the scale of finance, but alongside that, or the other side of that coin, really also has to be increasing the voice and representation of developing countries on the board. That really needs to be the other side of the coin, right? So it's not just about increasing the scale of lending, but how can developing countries play a bigger role in the World Bank's governance? We needed to create the Green Climate Fund precisely because many developing countries felt like they did not have a voice in the World Bank. So I think voice and representation is extremely important. Now, on the topic of mobilization of finance, as an institution that taps international capital markets, in terms of increasing the scale of lending that way, I think it remains an extremely important institution, right? Regardless of whether it can crowd in private sector or not. I mean, just by purely using its balance sheet without having to leverage a lot, with the help of the private sector, I think just by the virtue of it being able to borrow very cheaply and therefore enable, client countries to borrow on a very long time period in a way they simply would not be able to at very cheap rates. I think this is an extremely important value addition the World Bank brings, as well as a number of other regional banks. So I think we do have to keep that in mind. But let me stop there and thank you, Miriam, again for a very rich set of remarks.
Yeah, that's a really interesting point and slightly different kind of perspectives on the potential role of the World Bank, and we'll follow this up, of course, during the discussion. So looking forward to that. Just want to send a reminder to the audience that if you have any questions, you can pose them in the Q&A. So just click on the Q&A button and we'll get to those eventually after our panel discussion. So we have one more panelist, and that is Julie Siegel, who works as a Senior Manager of Climate Finance at Environmental Defense here in Canada, where she advances climate-related financial policy and regulation. So I think you're the only Canadian-based panelist, so curious to hear a domestic perspective. So go ahead, and then once Julie is done, we'll hear a brief reflection from Mariama.
Wonderful. Thank you, Ryan. Thanks so much to my co-panelists. My name is Julie Siegel. I'm based on Dish with One Spoon territory, Toronto, Canada. What we are focusing on here is climate finance, sure, but only as a means to climate justice and just transition. I want to reaffirm that focus because we're all on this panel not talking about how to get money into technocratic solutions to cut carbon in the atmosphere, but how to finance climate justice. And climate finance, as we've been talking about it, has two parts essentially. First is truly paying for a warming world, as this webinar is titled, right? Recognizing that we're locked in already to 1.1, 1.2 degrees of warming. And there's adaptation that has to come along with that, and loss and damage for the non-economic damages that are already locked in by historically emitting countries like Canada. So people are feeling that warming we've already locked in. Hundreds of thousands of people were affected by Pakistan's floods, to name one of many examples across the global, devastating examples across the global south. In the global north here in Canada, we're seeing floods, wildfires, food shortages. But the difference is that in the global north, given our infrastructure and geography, those challenges, those climate risks are not yet existential, but we're still feeling them. So there's global adaptation that needs to be financed. And of course, loss and damage, which my colleagues have talked to very well. So that's paying for a warming world, which should be primarily led by global north countries like Canada, based on our responsibility and accountability. we'll get into that in a second. And the second part of climate finance is essentially investing to avoid an even warmer world, right? So following the leading scientists' recommendations to end investments in new fossil fuels, which was supposed to happen as of 2021, has not. Globally, we're failing on this piece. We're succeeding slowly and moving towards, renewable energy and a lower carbon economy. But in this case, succeeding slowly is the same as failing slowly. So it's not enough. That's the framing here, the two pieces of climate finance. And Canada, as a wealthy, industrialized global north country, has a responsibility to pay for what's already locked in, pay for that warming world. We have another responsibility to limit further damages. This is something shared globally, but again, Canada, as a country with higher historical emissions, should be taking the lead, cutting our investments to, polluting investments much faster than we are expecting other countries to. I will continue to talk about some areas of true progress on climate finance from a Canadian perspective, where we have to go quite a bit further. I'm also going to touch on the role of the private sector, how the private financial investment is not pulling its weight yet, and how it should be more productive in this area, under the guidance of governments. Canada's role internationally, paying for a warming world. This is one area where, as a Canadian, I'm decently proud, for sure, of our climate action. At COP27, our Environment Minister, Stephen Siegel, was one of the leaders from global north countries on loss and damage. He led a report on transparency for the 100 billion goal, confirming that we are not yet there in terms of funding what we have to. Our governments continue to up its contribution to climate finance under the $100 billion goal. We're currently sitting at 5.3 billion annually, with a bunch of confirmations made to where that's going. Based on our historical emissions, it should be about $1 billion higher, but that was recently doubled from 2.65 to 5.3. So we're moving in the right direction and need to move further. When it comes to innovative climate finance too, there's one piece I wanted to mention from here at home that I would love to see scaled up. Canada has some lessons for, what we'll call innovative sources of financing. Essentially, when we're looking at loss and damage, other types of investment globally, generally climate justice points to the polluter pays principle, right? So countries like Canada should be stepping up to pay for our historical emissions. Recently, there's conversations as well about fossil fuel companies, being taxed for global climate justice finance. So one micro example I will point to in Canada, where we have a carbon tax, it's definitely imperfect, but it's modeled on redistribution. So most Canadians, the majority of Canadian households end up getting more money back from that carbon tax than they put into it, paying at the source for carbon. So it's intended to be a progressive redistribution model that's baked in with a polluter pays principle. So we're doing okay in Canada on paying for a warming world, at least our presence on the global stage, and slowly our capital flows as well towards adaptation and loss and damage. But we're not doing well on the other part when it comes to mitigating further climate change. Canada continues to subsidize fossil fuel infrastructure here at home, even though they've recently banned that internationally. We're continuing to invest in infrastructure that shows an intention to rely on the Canadian oil sands for a number of years, which are globally one of the most polluting sources of oil. So none of these sources of capital, none of these economic investments that Canada is making at home are just. The second area I'll look to is the private sector and investment finance. So this includes, as a very broad bucket, things like, multilateral development banks, World Bank and international development banks, et cetera. But it also includes things like our pensions, our banks, the companies. And the reason I'm pointing to this as significant is because private finance builds our economy, right? They're making investments every day into new things. And unsurprisingly, this is not, those capital flows from private sector are not going under principles of climate justice. They're oriented towards profit, not social or environmental productivity or climate justice, right? The Paris Agreement calls for making all finance flows consistent with low emissions and climate resilient development. Our countries, as signatories to that Paris Agreement, should then be holding their private financial sectors accountable to those principles. That is not happening. The significance here, again, private finance in many ways builds our economy. That's where trillions of dollars are flowing. With the rise of globalization, a Canadian pension can make an investment and decide what type of building or highway is constructed in a global south country. And if they're not investing in climate resilient infrastructure, then it's likely the community on the ground who is going to bear the damage when that structure doesn't stand up to climate damage. And I also use this to point out that the idea of limited funds for climate investment is a huge fallacy. Our banks, pensions, companies are investing in new things every day, but they are investing in things potentially that increase emissions, not that cut emissions and build resilience. We should not be using this as an eye-opening moment to say, great, the financial sector will solve this. It won't. We should instead be using this to recognize that we need to reorient and transform the whole purpose of financial flows. Are we looking only to make a profit, or are we looking for social and environmental productivity? Are we looking to align with our commitments under UNFCCC to mitigate climate change and do that equitably? So the financial sector is regulated in other ways, but not on climate. We shouldn't just be looking for leverage or to crowd in capital, but to regulate. Canada is particularly far behind on this. Globally, since the Paris Agreement, banks have invested $4 trillion in fossil fuel investments, entirely in the wrong direction from what we should be doing. Canada has been 900 billion of that 4 trillion Canadian banks. So that has implications at home and globally. Instead of trying to fit climate finance into profit-driven parameters, our government has to reset those parameters. So perhaps I'll close here saying that we need to highlight that climate action and climate justice are what should be centered, focus less on leveraging in private capital and more on redirecting it. We can't lose attention on this because every dollar has to be productive for climate resilience. And we should be taking the principles of climate justice, differentiated responsibility under the UNFCCC and stretching that to cover every single dollar that is building the next economy and structures that we're going to be living in.
Wonderful. Thank you so much, Julie. It's nice to have that kind of Canadian perspective close out the panel. So we're going to hear a brief reflection from Mariama, and then what we'll probably do is open it up to the panel to have a brief discussion, and I might kick that off with a question, and then we'll turn to some questions from the audience. So Mariama, do you have any brief remarks?
I have some brief remarks. Thank you, Julie. I know I fully appreciate and thank you for your intervention. And I definitely agree that the central pillar around climate finance should be grounded is climate justice and just transition, and that we need to figure out how to pay for the warming that we're locked in. And I have a lot of debate and discussion with different scientists, climate scientists, and some say we are beyond 1.5, we're not going to make it. And some say we still can make it. I'm not a climate scientist, but my gut says we are pretty close to that bridge. And it will take a lot to turn that around. And I don't see that willingness globally to do that. I just wanted to flag, because I think sometimes people aren't clear what adaptation is. And I just want to flag for adaptation is something simple, sometimes as simple as money for a person to build a house that can withstand, to move their house to a little higher plane to withstand flooding. And it can be as big as building seawalls, which we are familiar with in developed countries. I live in West Palm Beach, and every time you look, they're building seawalls and so forth. And it can involve, helping drug a drought resistant crop. So it's very big, bridges, from anything from tiny homes to big bridges, building bridges and seawalls. So that's what we're talking about. We're talking about adaptation. And that's where we're talking about when we talk about the inequality and what needs to go to women and men and indigenous people who are living marginal land, marginal housing, marginal everything, whose job and asset, whatever those are, needs to be protected, insured, reaffirmed. So thank you. And that's why loss and damage is important. I think the second part about investing to avoid even warmer world, definitely you're on point there. Two things I want to flag. We still don't have a definition of what climate finance is. So we are measuring something that we don't know, we haven't defined. And part of what we haven't defined it in CCC because the developed countries have refused to allow the technical people to define it because they want to be able to define what it is that they're giving. Okay, so I've seen donation of books as climate finance. I've seen all kinds of things. They want the ability. There's no way that we as a society, with all the technology and academics we have, cannot define climate finance. It's been going on for 5 years in the CCC. Because the developed countries refuse to have the standing committee and finance and the technical bodies come up with a definition that would hold them accountable. So we need to also refine that within our countries. And each of our countries must be using some definition. So, you know, that's the thing I want to apply. The other thing is the quantum and quality. You made the point about we can't rely on the private sector. Important, private sector is part of society. They have a role, they have a responsibility, they have accountability. But I want to say one myth about the private sector. The private sector did not evolve on its own. The private sector grew out of government-funded infrastructure, our roads, our tolls. And before that, they grew out of all of the labor that we accumulated, forced labor from indigenous people, from people from Africa, that provide the bedrock for the development. So the private sector is not a magic by itself, okay? So let's be very clear, the private sector depends on the society for its evolution. And therefore it has accountability and responsibility. And the good ones do very good thing, and they do employ people, not discounting all of that, but they constantly do need the government. The internet, for example, created by government. The medicine, we are still paying the private sector for these medicines, these vaccines and so forth, okay? So we have brilliant brains, but the private sector is not a miracle worker. So the government can function, and we saw that in the financial crisis. We saw it with the pandemic, that government can move when they want to. We see how much money is moved to finance the struggles in the Ukraine. Therefore, the idea that there's not enough money for climate finance is complete rubbish. Okay, and we need to stop that narrative, and we need to move forward and have our government be accountable for that. We also have an institution, the IMF, that has access to the creation of money that could be used for climate finance without generating debt. Okay, special drawing rights, and it also had a resilience fund. It created after the financial crisis of 2008. There's a whole bunch of money that was created. Most of that still went to the developed countries. They didn't use it. That's the SDRs that's sitting around. So there's money in this global economy, not just in the private sector, but within the public sector. It's a matter of willingness and a willingness. The debt becomes important because the debt is an instrument of control. Okay, we have proposal all over the UN for sovereign workout of debt mechanism. Why has it not been implemented? Because the developed countries use the debt as a mechanism of control, debt and debt services. And climate change is becoming that control mechanism also. So I just wanted to throw that in, and I'll be quiet now. Thank you.
Well, that's a great launching point, I think, into the discussion. And I'm going to invite all the panelists to turn on their videos now. And we do have a couple questions from the audience, but before we go there, I want to ask a follow-up to this discussion that has emerged about profit-oriented climate finance and then this tension between private financing and public financing, which I think gets to some of the questions also that we have in the Q&A. We heard a little bit from Mariama just now on this, and we've heard from some of the other panelists, but just broadly, how maybe this is a question for some of the other, for not Mariama first, because this is something you said, we don't want it to be a profit endeavor, which was an interesting point. So maybe you can clarify that briefly before. I'm curious to hear how other the other panelists feel about that. And if it's not profit oriented, which I think is personally, I think it's a reasonable proposition that you make, it raises questions about the how of climate finance in a capitalist global economy, which is very much dependent on profit, right? So from a sort of structural political economy perspective. So I know that's a big question, but maybe Mariama, can you clarify that statement? Did I quote you directly? You said we don't want climate finance to be a profitable endeavor.
We don't. I don't want it. What I'm saying is, it's not that profit cannot be made. Individuals are always going to make profit. Business, small enterprises are all done, but we don't want climate change. And climate change is a global public bad. Climate finance is a global public good. And I'm talking about climate finance in the restricted sense of under the UNFCCC, where we know there's a legal obligations. The private sector has no legal obligations. They have a moral obligation and moral responsibility. The legal obligation and the moral obligation is within the negotiations among countries that both parties have agreed that this is occur, right? What we see is that mitigation is more profitable, which is why most of climate finance is going to China, Brazil, and India, because there are big countries and you could get big mitigation projects. You're not going to get a big mitigation project in Jamaica or in Haiti. They want more, they need more adaptation and loss and damage. So that's not going to be very profit oriented, even though there's adaptation projects that can be profitable. Building a bridge, for example, or building an infrastructure can be profitable. But I'm saying it shouldn't be the driver of it, because it's recognized as a global problem and we know what the responsibilities are. It's on paper, the acceptability, the responsibility, Article 4.5, Article 4.1, Part 3, the Paris Agreement, even though they fought it, still accept that. So profits, yes, can be made, but it can't be the reason for moving climate finance.
Okay, that's a good clarification. So thank you for that. Leah, what's your response to that?
I definitely agree with what Mariama has said beforehand, but I also think that the fact that we now have so many studies and so much research showing the attribution of climate change to global north countries, showing that global north countries have received income gains for themselves that exceed the losses that have taken place in some of the poorest countries. It shows that there's a great disadvantage and that it's resulted in this chasm of inequality between the global north and the global south, which has then stalled sustainable development in the global south. And so in terms of whether climate finance is about being profit driven, it's about repaying the climate debt, as Julie and Mariama have said before. It's about repaying the climate debt, and it's about ensuring that there is climate justice, that there is equity, and it's about trying to pay back for the financial vulnerability and reduce fiscal sovereignty that's been created as a result of needing to redirect financial flows towards addressing climate change, which is something that global south countries have contributed to the least but are experiencing the most. And it is about ensuring that all countries have the ability to provide climate resilient public services and public goods. So it's generational. It's about addressing generational injustice that has been taking place. And I think it also comes back to this point around common but differentiated responsibilities under the UNFCCC. These are principles that were established to ensure that global south countries would be able to continue with their economic development, irrespective of the fact that they are also needing to address climate change. But under the current process to try and set a new post-2025 global climate finance goal, we're seeing this dynamic playing out, as I think Julie and Rishikesh have already highlighted, that we have global north countries saying that they want to expand the climate finance contributors base to include countries like Singapore and Qatar, but also countries like China and India. And in some cases, we have EU, the European Union negotiating bloc stating that they want to see some of the BRICS countries putting in place measures to reduce their carbon footprint, and in return they'll receive adaptation finance. And then you also have countries like China saying, we're already providing south-south flows and we want to continue receiving climate finance as well. Therefore, we're not going to give in to the demands of the EU for us to significantly scale up our climate mitigation ambitions. And I think this dynamic is, it's sort of muddying the waters, in the sense that we're not getting the time, we're moving further away from the principles of the UNFCCC, the actual convention text, and it's also stalling discussions and progress being made on things like the scope of climate finance, or in how to ensure that there are more economically just financial mechanisms being used for climate finance as well. And just to end on a point on private finance, I think I'm really concerned about the role that they're wanting to play in climate finance. At the Loss and Damage conference last year in Scotland, there were private sector representatives who were stating that they wanted to see how to make a profit out of loss and damage measures. And that to me is hugely alarming, because loss and damage measures are typically to reduce things such as loss of livelihoods, loss of culture, loss of heritage, but also loss of life. And the idea of trying to get some sort of financial gain out of those areas, I think is really alarming. And considering that most private finance flows are provided in the form of loans, it then creates this cycle of global south countries being indebted to a creditor, and private creditors are the least likely to come to the table when it comes to restructuring debt. And the impact is again intergenerational. So by including the private sector, we're reversing any sort of gains made in addressing the climate debt, or gains made in addressing intergenerational inequity. By including the private sector in its current form, there is a need to think about how to get these companies and corporations to think about their moral duty to addressing climate change, but we also need to ensure that they're following responsible lending and borrowing principles, such as those from the UN Conference on Trade and Development, but also ensuring that they're not doing more harm through their inclusion. I'll leave it there. Thanks.
Thank you, Leah. And one of the things I'm hearing in what you're saying, and in all of the panelists' contributions, is a return to core principles, really, of just things we've been talking about for 30 years, really, or more. Okay, we do have a lot of questions building up in the Q&A and not a whole lot of time. So I'm going to ask Julie and Rishikesh to give some quick remarks on this question. Then we're going to see if we can get to some of these questions.
Super. So, I mean, we're talking about economic justice and climate justice, and looking to the private sector. We're right to be very thoughtful about how they're participating here, right, to the core of this question. Because if the private sector participates on their current terms of prioritizing profitability, it creates degenerative feedback loops, right? So one example here is, let's think about physical climate damage, so natural disasters. A financial institute, a private investor is going to look at that as risk, climate risk to their investment. If they are focusing on climate investment in that purely profit-driven way, they're going to look at a region more vulnerable to climate change and say, this is not an area where I should be investing in, which risks capital flight from the regions that most desperately need affordable access to capital for adaptation, perhaps even mitigation. So prioritizing, reducing climate risk to that institution so they can be more profitable ends up having negative global implications for climate progress, and certainly localized negative implications for climate resilience and access to basic infrastructure that's needed to weather this storm. Another degenerative feedback loop is if we look to biodiversity. This is an area which is incredibly concerning because investors are starting to step forward with a lot of pizzazz to, engage with biodiversity finance. But just like adaptation, that's harder to monetize and to get a profit from.
So I don't know if this is just me, but I'm.
No, I can confirm that there's a problem with Julie's connection as well. You just move on, and then I'll messenger to
Sure.
I'll messenger via the chat.
Okay,
I
Rishikesh.
can hear you
sorry.
also. Apologies.
Oh, that's okay. So thank you, Julie. We'll turn to Rishikesh and then we'll approach a question.
Yeah, great. Thank you. I just wanted to say two things very, very, very briefly. The first thing is in regards to financing from multilateral development banks, especially climate finance. I think the core principle I think to keep in mind is that it really has to be growth enhancing, right? The idea really must focus, I think, on making sure that the quality of climate finance actually helps to increase economic output in these countries, if that's one piece. The second piece, of course, is making sure that vulnerable and marginalized populations are protected and that we build resilience, right? I feel like those are some of the key tenets and principles that should be reflected in terms of how we think about climate finance. So I think as sort of first principles, those really should be the basis. But yeah, let me pause there. I know there's a lot of questions in the chat.
I was on mute. Appreciate that. Thank you so much to all the panelists for your comments. I know it feels tight when we don't have much time left, but we should get to some of these questions. Is there, maybe I'll ask you to use the raise hand function when we're approaching these to see if you have an answer. There's a question from Tristan about public banking solutions. So according to research by Thomas Marois on public banking, there's 910 public banks worldwide, which have assets collectively worth 49 trillion US dollars. Can you speak to the potential of innovative public banking solutions in contrast to the dependents mobilizing private financial interests? It gets to some of what we were talking about earlier about considerable amount of this 100 billion or not quite $100 billion being private oriented loans, not grants. Any takers? It's okay if
I'll jump in.
Sure.
Just sort of briefly on this. I think we've been discussing about multilateral development banks, but of course national development banks are extremely important, and you'll often hear a constant complaint that there aren't enough bankable projects. National development banks are very much close to the ground. They know the exact landscape they operate in. And so I think, we really, and the Green Climate Fund and the Adaptation Fund have been thinking about how do you give direct access to national entities. And so I think it's really important to really think about how can you leverage the expertise that national development banks really have so that there isn't this, concern about are there enough, even enough projects going around.
Okay, appreciate that. So we have two questions from Alexandra Zeitz. I'm going to focus on one aspect of the first question. What the question is about the IMF. We talked quite a bit about the World Bank. The question is about the IMF, and Alexandra points out that some of these reforms at the IMF were responsible for the newly created Resilience and Sustainability Trust, which was one of the policy demands of the Bridgetown Agenda. I'm wondering if anyone wants to touch on that, particularly through the gaze of the Bridgetown Initiative. Has this been an important development? Does that inform your analysis of the IMF? What's happening there? Rishikesh?
Yeah, sorry to jump in again, but I've been following this piece particularly closely. So as Mariama was referring to earlier, there was an attempt to rechannel these special drawing rights because most of them went to advanced economies given the quota-based nature of these allocations. And so in a sense, the Resilience and Sustainability Trust that is housed in the IMF is a bit of a pilot for what the Bridgetown agenda proposes in terms of another allocation of $500 billion that would then, help to, scale up financing. So that fund is already operational. That trust was established last April, but it's small. It's only $40 billion, and not all of the SDRs have actually been fully committed. And so it's been a it's been a pilot run, and I think what Bridgetown is proposing is to really scale that up. And the good thing is that we already have some evidence in terms of how that could work.
Okay, thank you, Rishikesh. Leah, do you want to add?
Yeah, I can add briefly on the Bridgetown initiative. I think that it's one that has come at a pretty timely moment, but I also think that it's one that a lot of organizations and institutions, including my own organization, are still grappling with and trying to get our heads around. I think that it's something that can be seen in light of this idea of expanding the climate finance contributor base. So if looking at the proposals listed within the Bridgetown initiative around increase of special drawing rights, inclusion of the private sector, looking at restructuring of certain assets and trying to strengthen existing mechanisms. I think that it all ties into this discussion around trying to enforce the sort of moral reasons for providing climate finance, but also looking at what are some of the sort of technical solutions towards addressing that. But I also think that some of there's a need to ensure that the initiative doesn't only look at low and middle income countries, but looks at the sort of overall global south as well. I think there's been some concern that it would only focus on upper middle income countries or small island developing states, and there's a need to ensure that all countries feel as if they're being brought along in the process to ensure that there are equal access opportunities as well. But I think that some of the other points that are coming out of European countries are around wanting to ensure that we're not sort of impacting the ability for other financing streams to also be strengthened. But I view that more as a sort of stalling tactic from some of the European countries by saying we shouldn't be, by essentially saying that we shouldn't be creating a greater focus on global public goods, but should be looking at some of the traditional financing streams that currently exist. So I think with Bridgetown, there's probably going to be a lot more information that starts being shared by different organizations.
Mm-hmm.
But for now, it's just about being cautious and monitoring things.
And we'll see how that discussion picks up or follows through at COP28, which would be interesting to see. Okay, I'm going to ask a question about COPs in the context of Chelsea Dunn has asked two questions, and if Chelsea will forgive me for kind of moving one of these questions in a slightly different direction, because we did talk a little bit already about this sort of profit-oriented side of things. I want to talk about this idea of outcomes from COPs that was invoked in Mariama's comments. You mentioned how we're making, I can't remember the exact wording, but there's these sort of successes or these sort of announcements that come out of each COP, but there's also this trouble mobilizing genuine action coming out of COPs. I'm curious to hear what whether the panelists feel there has been a success in terms of moving the needle, if you will, over the last 30 years or even more recently. There's a really interesting chart that shows the sort of climate projections, warming projections, and this is a Bloomberg figure, and we know that those projections have luckily, thankfully, declined from the kind of the crazy, warming trajectories that were expected, earlier this century, and now it's not quite as crazy, although it's still still very frightening, how much warming appears to be what we're moving towards. Do you see progress in the COPs? Do you see that these events are useful for, in particular for climate finance, but also just for climate change mitigation more broadly? What do you feel about the COPs? This is the Conference of the Parties for those following on.
That is a tricky
Julie.
question. Julie is going.
Is my connection back?
Yes.
Oh, I just got a notification. It's unstable. Okay.
We can
We're
hear
well?
you. So keep going.
Sounds good. I know we're tight for time, so I'm sure Mariama has some thoughts here too. But I mean, from my understanding is like we were on track for about 4 degrees or more of warming, right? We've whittled that down to an unacceptably high level, which is much lower than 4 still. Estimates range between 1.7 to 2.5 to 2.7 from what I've seen. And that trajectory is very much because of what has been put forward since the Paris Agreement, and in many parts because of it. COP is an insufficient process. That's not the entirety of climate action or climate policy. I see COPs as a moment for accountability when countries should be checked up on to see, are they moving forward on their progress that they've committed to under the UNFCCC. It's a very important moment, I would argue, for global stock taking and accountability. But all of the hard work has to happen between the COPs. Some work is happening, but not enough. The 100 billion is a clear example of a promise unfulfilled. Loss and damage is something that we need to move forward on, and a dozen other things to name. But COPs are an important moment that spur progress. But then at home, each of us in our countries need to hold our governments accountable, particularly in the global north. I suppose that statement is true, to move forward on those promises that have been made.
Thank you, Julie. Do any of the other panelists want to jump in? So we can move on to a next question. Okay, not seeing a hand. I'm gonna take Fajr's question and tweak it as well a little bit. Fajr pointed out, I think it was Mariama who was pointing out this sort of, if the global West can spend, hundreds of billions on this war, it's a sign that they might also have finance for climate change. And I want to just pick that up and turn that into a bigger question about the geopolitical context right now that we face. This, some political economists have talked about this idea of polycrisis. Not only the war in Ukraine, but we have a global inflation crisis. We're coming out of a pandemic. Some might say we're still very much in a pandemic. How has this broader context shaped the ability or willingness of countries in the global north, which are responsible for the majority of climate warming and are supposed to be paying into these funds? So how does that shape their willingness, their ability, the political will, the polities will in these different countries? Any reflections on that?
I can start.
Thank you.
I have two conflicting points on it. I think one is that, I've followed negotiations for many years, trade, climate, and so forth. So I see the horse trading, and you can see, and I talked to friends of mine who still follow it, that even the loss and damage was, again, a carrot for the South to be good people, to, here we are, we're giving you this loss and damage. So, be okay with what we're doing in Ukraine and don't say too much. So it goes both ways. It's always a trade-off. It's not ever just about climate. It's about trade. It's about security. So there's always this dynamics going on. And you see time and time again where it's used. But at the same time, we also know that the implementation of the war means that climate change is on the back foot, right? That climate change is worsening. There's no question that emissions will arise. Developing countries, some countries will have to, will use it as a pretext to say, well, we don't want to do what we promised because we now must meet these different, and some of it may be real, some of it may be imagined, some of it may just be useful. So it can go both ways in this dynamics, right? And I think we just have to watch and see and be very agile and to be very politically conscious to see how different trade-offs are being made and where we're using sweeteners to get certain groups of countries to come on board certain position. So we offer certain things, but we have no intention to implement it. And so that's why I'm saying the implementation, these wonderful things, I've seen them over and over. It's the implementation. When we get back to, before you get to COP28, there'll be a meeting in March and there'll be a meeting in June in Bonn or wherever. And they'll be fighting again. Okay, who made this decision? Why did we made it? And we didn't say that. This is what we meant. And the whole text will be torn apart and torn apart. And then we get to COP28. And if this war comes on, there'll still be need to have certain South countries join. So we'll get another sweetener. So, you know, there's all this trading back and forth. It's never just about what's on the table. It's the whole geopolitics is always informed UNFCCC discussions. And every other discussion that I've been part of is never about the subject matter on the table solely. It's always about what else is going on, how we shift the board to look good, to bring countries on, whether it was the war against Iraq, whether it was the war, you know, we see different things and you can go back and see the trajectory of it. So we just have to be very careful and not accept everything on face value.
Okay, appreciate that. I like the mantra. It's always about trade-offs and it's always about geopolitics and it's always happening in the background. For the sake of time, I think Leia's comment is going to be our final one. So Leia, just a final comment to you and then we'll close up the panel.
Yeah, I'll try and be quick. Just on the point of the geopolitics and whether there's more climate finance coming or not. I think as a result of this poly crisis, we're seeing that more climate finance contributors are including their own interests within climate policies and agendas. So we see things like the Repower EU package that came out from the European Union last year, and it includes this EU external energy strategy, which it's essentially around providing technical and financial support to EU neighbour countries, but also countries in the global south. But in return, the EU would like the ability to be able to build more fossil fuel infrastructure in these countries or extract raw materials from these countries to support renewable energy infrastructure in Europe. And I think there's a clear colonial mindset of decarbonising the EU by shifting its fossil fuel infrastructure to the global south and additionally extracting those resources. And it comes back to this point around ensuring that there is clear country democratic ownership of climate finance strategies and of the policies that are being designed. Thanks.
Well, thank you, Leia, and that's a good way to end the discussion. And I want to take this moment to thank all the panelists for sharing their wisdom and their expertise. I've really enjoyed this session, the last hour and a half, and learned a lot, and my selfish interest has been fulfilled. So thank you so much. And thanks again to the audience for joining in, and I hope you all have a wonderful rest of the week. And we'll see what happens in terms of COP28 with climate change finance. All right, thanks again.